today's World Insight. A hike in key U.S. rates as the Federal Reserve doubles down on raising borrowing costs to curb inflation. But how wise is the policy amid fears of contagion in the U.S. banking system after the collapse of two big banks? How do higher U.S. rates affect other economies? And democracy, a shared universal value for humanity. But how does democracy work among diverse and different nations?
And here is our host, Tian Wei.
Hello and welcome to World Insight with me, Tian Wei. The U.S. Federal Reserve raised a key rate on Wednesday, the ninth in 12 months, to rein in inflation. The Fed announced the decision despite fears of a contagion over the collapse of Silicon Valley Bank and Signature Bank a couple of weeks ago. SVB is the largest U.S. bank failure since 2008 financial crisis. How prudent is the Fed's policy of tightening credit despite bank runs in managing inflation? What does it mean for global financial markets and on other major economies, such as China? For answers, let's loop in our panelists. Joining us in New York, Anthony Chen, former J.P. Morgan Chase chief economist. In Hong Kong, Hong Hao, chief economist at the Grow Investment Group. Gentlemen, welcome to the program. Latest reaction to the Fed's raising interest rate, 0.25%. Let's go to Mr. Hong.
Well, I think the market seems to be expecting this. But I think, on the day, the market reacted really badly to Yellen's comment about not securing all the deposits in the U.S. financial system. So I think people got sort of spooked, and because people were hoping for some sort of, at least some sort of implicit guarantee instead of explicit, refusal to guarantee all the deposits. And I think that really took people by surprise. And as a result, the market reacted really badly that day.
What do you make that the raise of interest rates continuously would have on the banking sector?
Well, I think that it's very clear that the problems that you had in the banks was exacerbated by the high long-term interest rates, because many of these banks bought safe securities like treasuries or mortgage-backed securities back in 2020 when interest rates were very low. And then all of a sudden, as interest rates go up, guess what happens? The value of those securities goes down. That's bad, except for the fact that many of these banks sort of corrected for that by separating those securities into two different categories. One, those that are available for sale. In that case, those are marked to market, or those available for maturity. Those are not marked to market, so you don't have to realize those losses. That's great. The problem, however, when you raise interest rates and depositors realize that you have such a huge amount of your portfolio or your assets in these type of securities, they get nervous and they pull money out. And as they were pulling money out, they had to take money out, not just from the securities that were available for sale, but also those that were available for maturity. And that was the real problem that these banks like SVB faced in that situation.
Do you see with the continuous raising interest rates, there will be more nerves from those who save money in the banks, and therefore, as a result of that, these types of banks might be going underwater in a bigger scale? That at least is the concern.
It is a concern, but of course, the regulators have moved very aggressively to sort of dampen those concerns. And the way they've done that is to basically say that the Federal Reserve now has a borrowing facility where you can take these securities that are underwater. Let's say that they're 20, 30, 40% below market value. The Federal Reserve has already promised that you can bring those securities to the Federal Reserve and they'll lend you money based on the full par value. So there's no loss and you don't have to have a panic sale. But still, given the fact that they have to borrow at higher rates, it still is a burden for these banks. But we're moving in that direction. And then certainly the Treasury and the FDIC and the Federal Reserve making a sort of a combined statement that the government is going to be backing all the deposits, both the insured and the uninsured deposits in these institutions that are having problems, are in fact helping. However, there's one important point to bring up here, and that is that if you look at the amount of insured deposits, they're about $7.4 trillion. But that also means that the remaining amount, over $10 trillion, are uninsured deposits. And so even if the government says, I'm going to promise that I'll pay those, it's a lot of money. And by the way, how much money does the FDIC have? The Deposit Insurance Fund only has $128 billion. So how can you insure so many deposits?
I think, well, after the Silicon Valley Bank, people have been, withdrawing money from the system, not just because what Anthony was saying, just now, but also because, more than that, also because money market fund is offering like 4% interest rate return, right? So, and it's considered risk-free. So, people are taking money and putting into money market fund as well. I think, the U.S. government is between the rock and hard place, right? So you're making a promise that you can't keep, but you have to make this promise hoping that people won't hold you to that, right? So, there's a sort of a dilemma here. And also they have to balance between, moral hazard and also, who to bail out, et cetera, et cetera. So it's a very complex situation. But I think, the authority has moved very, very aggressively and makes sort of implicit guarantee, not only guaranteeing all the SVB and also signature banks deposit, but also beyond that, there's an implicit guarantee that, all deposits are safe.
How do you see not only what is going on with the Fed, but also the ECB and the other players in the market?
Yeah, inflation rate in Europe is still more than 10%, right? So they have a harder problem at hand and they have to fight it, right? So because if inflation got out of control, then the European economy would be in deeper trouble. I think this year people were hoping for lower interest rate, lower inflation rate, because oil prices come down, shipping freight rate has come down, et cetera, et cetera. So there is really no excuse, right, to see inflation is still well above 10%. So I think Christine Lagarde made the right choice. On one hand, she emphasized that the banking crisis has to be dealt with and has been dealt with by the authority. But then at the same time, they really have an inflation problem at hand. They have to fight.
On the other hand, Mr. Hong, how should we understand the ripple effects of the Fed, both on the U.S. banks and also on the banking sector in different parts of the world? And the other thing is, what does that mean for the U.S. dollar and for the bigger impact it's likely to set eventually as things evolve?
Yeah.
Please.
Yes. Well, I think the Fed is trying to raise interest rate to fight inflation, but then at the same time have to balance the financial risk as well. There is a real contagion risk, because, after the SVB and Signature Bank fell, all the other smaller regional banks experienced cash withdrawal, right, by depositors. And people are trying to move money to those banks, the bigger banks that is perceived being safer. But at the same time, we said that if everyone tried to take cash out of the banking system would collapse, no doubt. All right, so they have to balance this risk. But I think for now, they're doing a relatively good job. If you look at the market reaction, the market, even though it has been very volatile, but it didn't create a situation where the market plunged and creates even more fear in the system, right? So I think for now, they're doing a relatively good job.
What about for you, Mr. Chen?
I was actually very impressed because the Federal Reserve certainly has to deal with the financial stability issue and also the inflation issue. And what they did was the right thing, in my judgment. I agree with Hao, because right now, the market was overwhelmingly expecting the Federal Reserve to raise rates by 25 basis points. Yes, 2 weeks ago, there was some expectation of a possibility of a 50 basis point increase. But if you look at the implied probability, looking at the futures markets, the probability of a 50 basis point was 0, while the probability of a 25 basis points was over 80%. So the Federal Reserve did not disappoint the market, and that's why the reaction was not as negative until the Treasury Secretary made that statement, which I mentioned. She took it back today, but that was the reason. But the Fed chairman's words were very comforting. And right now, as we look at the futures markets again, the futures markets are not expecting another 50 basis points. They're expecting, with about a 34% probability, another 25 basis point increase. But I think the markets and myself are now coming to the view that perhaps only one more Fed tightening will need to take place, because one of the things the Fed chairman pointed out correctly, and that is that if you have tightening financial conditions or tighter credit conditions, that itself would do some of the work for the Federal Reserve, because it will slow down economic growth. Keep in mind that these banks, if they're constricted in the ability to gain more money or to worry about deposit outflows, they'll make less loans. And so if they make less loans, there's slower economic activity. So the Federal Reserve may not have to be as aggressive as it would have had to be if somehow this banking situation had not developed.
Mr. Hong, tell me more about the U.S. dollar thing. Of course, many around the world are looking at the Fed's actions, mainly with an interest in knowing where the U.S. dollar is going, and therefore their own local currencies, how it would do, including here in China. Of course, there's always the issue of the treasury bonds that China has of the U.S., and also others who are also selling, it seems, over the past year or so. Tell me more about your thoughts.
Yes. Well, normally in a risk-off environment, people would flock to the U.S. dollars, right? Because that's perceived as the safest currency. But I think this time around, people seem to be moving away from the U.S. dollars, right? So the U.S. dollar actually weakened during this crisis, and at the same time, if you look at what the Chinese yuan is doing, the yuan has strengthened substantially, right? So I think that is a relative strength between the U.S. economy and the Chinese economy now, because the Chinese economy is being perceived as an economy that is emerging from last year's COVID-0 damage. And I think the economic cycle is turning around with the help of the Chinese central bank. So, overall, if you look at the numbers in the first 2 months, the economic numbers is unusually strong, right? And lending activity is heating up as well. But then on the other hand, the U.S. economy seems to be in a really tough place, in the sense that inflation pressure is still very high, and at the same time you have a banking crisis at hand that you have to deal with. So I think that is the reason why we're seeing relative strength in the Chinese yuan, but then at the same time people are moving away from the U.S. dollars, because the U.S. dollar, the U.S. economy is weakening.
What determines foreign exchange rates are relative interest rates and relative economic growth. The Federal Reserve pointed out that they expect economic growth this year in 2023 to be only 0.4%. The Chinese government announcement was that you're going to get real GDP growth of around 5%. So clearly there's a positive differential when you look at China versus the U.S. And then with regard to interest rates, Hao is correct. The interest rates are going up, but the market is now perceiving that interest rates may not go up as much as they otherwise would have gone. So even there, the differential is there because China has no reason to raise interest rates. But if that differential is much lower or much narrower than the market was expecting, that also puts some downward pressure on the U.S. dollar. So on both of those fronts, the marginal movement is towards less strength for the U.S. dollar.
Of course, there was quite a big alarm clock for Credit Suisse latest performance. The Swiss National Bank and also the national government has made the decision. But still, we see it is not just being contained within a few local banks in the U.S., but also going to Europe, and many wonder whether this is a prelude of something more serious to come. Remembering that the last financial crisis, 2008, many things happened in 2007 rather than 2008. So Having said that, though, it might be different this time. So what do you think is the situation we're facing right now, Mr. Chen and then Mr. Hong?
Well, I think in the case of Credit Suisse, they've had a banking problem for years. This is not a big surprise. Now, all of a sudden, where investors are now looking with a very bright light to see what the problems are there, it certainly raised the awareness that there were issues with Credit Suisse. It's a huge bank, so there's no way that the central bank was going to let Credit Suisse go under. So obviously, they encourage UBS to actually get more motivated to perform this so-called shotgun wedding, where both participants at one time were not that excited about the merger. But it was a very good deal for UBS because the couple of days before the merger took place, they ended up purchasing Credit Suisse for about a third of the price of what just a few days before their market cap was. And it allowed the regulators to move in very aggressively, use the capital absorbing bonds to help the situation. Even the shareholders got a little bit out of it. So we're making some progress there. I think that what's encouraging for me is that all global central banks are paying attention to this. The Federal Reserve joining the European Central Bank and the Bank of Japan and other large central banks, Bank of Canada, to actually provide dollar swaps more frequently on a daily basis instead of a weekly basis. So I think regulators are not asleep at the switch. They're certainly doing something about it.
Even though now we are seeing like a smaller scale crisis here and there, but banking crisis such as this, tend to signal some bigger hidden problem in the system, right? So we may have even more bank failures to deal with later on, right? So I think, in such an environment, it is really not auspicious for global growth, especially, if the US is slowing down and probably going into a recession, even though the Fed is not forecasting a recession. But if you look at the yield curve, if you look at the short-term rate and the difference between the spot rate and the futures rate, then, you clearly see signs of stress in the system already. And I think Europe, just now we mentioned that, Europe has a very high inflation problem to deal with. So in 2023, I think the only growth that is left in the world is probably coming from China. So, but even for China, we still have a lot of work to do, right. Even though we have a really good first 2 months. But I think, we really need to see a real recovery in the property sector, before we can declare that, all is clear for the economy here. So I think, for the year of 2023, China holds the key to global growth.
Everybody has their work to do. Hopefully they're doing it well. Thank you so much, Hong Hao and also Anthony Chen. Appreciate it, gentlemen. Thank you.
Thank you.
Thank you.